Good evening, students. We are in the concluding part of our LVRC classes for the upcoming attempt. And today we are going to discuss some very important updates which will be relevant for this exam. And I'll try to take up some important questions at the end, which I'm sure will be very helpful for you to handle the comprehensive questions that you may expect in your exams. So let me start with the updates first. So as we all know that whatever is applicable to us for the upcoming attempt is what is applicable 6 months prior to the attempt. So generally you can say before 1st May 2026, whatever are the updates in all the laws, whether it is GST law, customs law, or FTP, that will be applicable to you. So keeping that in mind, we'll be discussing our today's updates. Also, we have to understand that Finance Act 2025 is very much applicable to your attempt, but Finance Act 2026, though the act is passed, but I'm sure you all would be knowing that the provisions of indirect taxes, majority of them are deferred by the deferred for its applicability. So they have not yet been made applicable in this period, which is applicable to us, except for one amendment of intermediary that I'll be explaining you. But all the other amendments of the Finance Act 26 are not made effective yet. Hence, they will not be applicable to your upcoming exams. So let me first start with goods and services portion. Just 1 minute. Okay. Now, as we all know that in the charging section, we have the forward charge under section 9. Then we have the reverse charge under section 9.3, 9.4, 5.3, 5.4. 9 is of CGST, 5 is of IGST. And on similar footings, we have 9.5 and 5.5. Now, what is this 9.5 and 5.5 dealing with? I'm sure you all would be recalling this. 9.5 of CGST and 5.5 of IGST, they both deal with the special provisions where the responsibility to pay tax has been cast upon neither the supplier nor the recipient, but a third person, which is the electronic commerce operator, that is the app through which those services are provided. Now, firstly, we all know that even goods are supplied through apps. However, 9.5 does not cover supply of goods through app. So one thing that you have to be very clear that whenever you are getting supplies of goods through app, like the common supplies which we are getting through Myntra app, through Flipkart app, through Meesho app, when you order different apparels, footwears, cosmetics, these are not covered in 9555 because these are all supply of goods through the app. What is covered in 9555 is only supply of services, that too not all services, only the notified services. So whenever some notified specified services are supplied through the app, and the app is called as the e-commerce operator, the law provides that in case of those specified notified services, the tax on those services will be payable by the app. And for that purpose, the app has to take us registration, and it also needs to have physical presence. If it is not having, then it has to appoint a person who will be taking the responsibility. Now, moving ahead, the list of services which are notified for the purpose of this app originally were in notification 17 bar 2017 of central tax and 14 bar 2017 of integrated tax. Now this list has an amendment wide the latest notification which is 17 bar 25 and 17 bar 25 of both central tax and integrated tax. Just let us run through all these services along with the amended service. So what are the different services that have been covered in this category? First is transportation of passenger by radio taxi, motor cab, maxi cab, motorcycle, or other motor vehicle except omnibus. Why? Because omnibus is covered in the B category. Now, both these we can discuss together. So B category covers the service of transportation of passenger by omnibus. Now, in both these cases, what is important to be noted is that nowadays these apps have become very common. We are using it day in, day out. So examples are Ola, Uber, Rapido, and many more in different places. Now, all these apps, what they are providing is transportation of passenger by radio taxi, motor cab, motorcycle, or other motor vehicle, including rickshaws, etc. So when these services are provided through these apps, that is, you book a cab through these apps, the charges that you pay for the transportation, the tax on that will be payable by the apps, that is the e-commerce operator. Similarly, if you are booking omnibus through the app, except where the person supplying the service is a company, so that is an exception, because if the person supplying the service is a company, it will not be covered here, then it will be under forward charge. So where the supplier is not a company, then again, the ECO, that is the app through which you are booking the omnibus, the charges for the transport will be leviable to GST and the tax would be payable by the app. Then comes the third category, that is accommodation. Now this is again common. Whenever we are going on a vacation, on a trip or a travel, we book hotels, guest houses, clubs, campsites, or other commercial places for the purpose of our lodging. All these places we are nowadays very frequently booking using apps. Again, you have numerous apps. You have Make My Trip, you have Go Ibibo, and so many apps. Now, whenever you are booking a hotel through these apps, again, that is notified under this category, but with a condition. You have to make a note of this, that in case of hotel services, there is an exception. That is where the person supplying the service, that is the hotel. Now I'm just using the word hotel, it will cover everything, hotel, guest house, etc. If the hotel is itself liable for registration, why? Because the turnover of the hotel exceeds 20 lakhs. So where the hotel is liable for registration, in that particular case, this particular 9(5) will not apply. Then the hotel will be liable to pay tax under forward charge. However, where the hotel is a small hotel, not liable for registration, that is not exceeding the registration limit, in that particular case, the app through which you are booking the hotel will be the person liable to pay the GST on the hotel accommodation service. Similarly, a very common service is housekeeping, which includes plumbing, carpentering, etc. So we nowadays in all these major cities, people who are going there for their purpose of employment, etc. So even for getting a house help, a driver, a cleaner, a plumber, an electrician, or a cook, we are using these apps. Again, there are multiple apps. The first one, most common one, which I'm sure everybody would be knowing, is Urban Clap. Then later on, there were multiple apps. So whenever you are booking any type of housekeeping service, again, it is one of the notified service, but with the same exception like hotel, that is the supplier of the service, that is a carpenter, plumber, should not be a person liable for registration. If the carpenter, plumber, driver is itself liable for registration, then they will be paying tax under forward charge. If not, then the app will be required to discharge the GST on this service. Then comes another recent amendment just done few years back. That is, whenever you are booking food, again, multiple apps, we know, Swiggy, Zomato, so many apps. So when you are booking food through these apps, So whenever the apps are supplying the restaurant services, that will be covered over here. However, what is the exception over here other than where the service is supplied by the restaurant, eating joint, etc., located at specified premises. Now, what is a specified premise? So, if your hotel or your restaurant or your eating joint is part of a hotel where the rate per unit of accommodation that hotel exceeds 7,500, then that place is called as a specified premises. If a restaurant is in such a hotel, so basically it is a 5-star, 7-star hotel, and there is a restaurant attached to that hotel, for booking food from that restaurant, the tax is payable by the restaurant itself. In all other cases, where the restaurant is either a standalone restaurant or it is part of such a hotel where the per unit accommodation rate is not exceeding 7,500, in such cases, the person leviable to pay tax on the restaurant service, that is a food service, is the app and not the actual restaurant owner. Now, in all these services list, a very recent amendment is nowadays the new type of services being supplied, which the law has called as local delivery. Now, again, these apps, these are porter apps or many apps, but porter I think is the most common one. I'm sure everybody would be knowing. So whenever you want to get any of your goods, any of your documents, anything transported from one place to another, and generally it is doing it within the city limits, not beyond that. That is why they have used the word local delivery, though interestingly, they have nowhere defined local delivery, but I will call it as local limits or city limits. So whenever you are booking any type of service where the person will be picking up that particular goods, documents, bag, laptop, whatever from one place and deliver it at the other place within the same city limits, then that particular case will fall over here. Again, there is an exception. What is the exception? Where the person supplying service is itself liable for registration. So again, the same exception which was there earlier for hotel accommodation and for the housekeeping, same exception is over here. So where the person doing the delivery service is already having a turnover exceeding 20 lakhs, then it is a different story. Then the person doing the delivery service will be itself liable to pay tax under forward charge. But where that is not the case, because many times you find that individuals register themselves on these apps and they have their own small vehicle through which they are doing this delivery service. And this is a very good growing employment opportunity, rather a self-employment opportunity for many such individuals. So these apps will be responsible for paying tax on the local delivery services provided through their app. So this is an important amendment. I expect a question in this upcoming exam on this. In fact, there is a linked amendment in the exemption chapter also to this. But for the time being, I would like to inform you that this is a very important amendment that you should keep in mind. Now, I'm sure you all remember that in September 2025, we had a council meeting, 56th council meeting, which announced multiple rate reductions across the board. Over there, in fact, not even rate reduction, they in fact scrapped two of the slabs, the 28% slab and the 12% slab. So those slabs were also scrapped. At that time, majority of the rates have changed. Now, what are the new rates? Now, since rates is not a concern for us at our exam level, hence we are not studying the rates in detail, but for one or two items which are very regular and common, you should be knowing the rate. So in this, we all know GTA. For GTA, I'm sure students, you know that for GTA first, there is some exemptions. So you have to first check whether your service is exempt or not. If it is exempt, anyways, it is out of taxability. Other than exemptions, remaining GTA services will be taxable. But you would be knowing that a GTA is given the option to either pay tax under forward charge or under reverse charge. Within forward charge, the GTA had two options: 5% without ITC, and earlier it was 12%. But now, since the slab itself is scrapped, it is merged with 18%. So now the new rate is 18% with ITC. And for RCM, it is always 5%. So this is what is the amendment. So the amendment is that the option of 12% has now gone, because anyways that slab itself has been scrapped and it has been changed to 18%. Same amendment in case of renting of motor vehicle for carrying passengers. So in this particular case, again, there were two options, 5% and earlier 12%. This 12% is scrapped and it is now merged with 18%. So all these amendments are effective from 22nd of September. Again, I repeat, though we are not required to learn all the rates, but these are two very common services which are asked. So that is why we are discussing the rate, and it is an important change. So what was earlier 12 has now become 18 for both goods transport agency, that is GTA, and for renting of motor vehicle for transportation of passengers. Now here, interestingly, there is a small anomaly that when they change the rate notification, that is a notification containing the rates, they forgot to make a parallel amendment in the RCM notification. So unfortunately today, RCM notification is still making reference of the earlier rate of 12%. But when we read this harmoniously, we have to interpret it as 18 only, even though that amendment is not made, but that is only a, you can say, a clerical type of mistake. So you can very well ignore that mistake. So even though RCM notifications still make a reference of 12%, you will read it as 18%. Now, students, coming to another chapter. Before that, we have one of our very good students, Swaminathan. Hello, Swaminathan. Hello, Swaminathan. Are you there? I don't know whether he can hear me. Anyways, now, again, we had amendment in the exemption notification, again brought about around the same time of September. Now in exemption notification, the first amendment is in the GTA service. Now in GTA, what is the amendment is the same point relating to that local delivery. So first is, in case of local delivery, it is clarified, or we saw that it is put in 9.5. So the tax will be payable by the app. Again, in relation to that, there is some parallel amendment made in the GTA service. Now we all know GTA, there is exemption, right? In that GTA related or goods transport related exemption, there is this particular explanation added. Now, firstly, let us understand what is the purpose of this explanation. If you read the exemption entry, the exemption entry reads like this, that wherever there is a service which is by way of transportation of goods, that is exempt. And then they have carved out exception, which says that it will be taxable in two cases. Wherever the transport of goods is by GTA or by courier, it will be taxable. Now, what is clarified is that nothing contained in this entry will apply where you are doing this goods transport in the form of local delivery. So wherever the goods transportation is done by local delivery, this particular entry, that is the exemption, will not apply. So this is clarified, and this is very relevant or very what you say required amendment. Why? Because if you read the entry, original exemption entry, it actually exempts all transportation of goods, and then it says except. It means it has made GTA taxable, it has made courier agency taxable, and it has made inland waterways taxable. Other than that, if you are doing any type of goods transportation, it will be exempt. Now, if you look at this local delivery service, which has recently started in past 1 or 2 years and now becoming very common, interestingly, these local delivery services do not fit in GTA, neither they fit in courier, and obviously they're not inland waterways. So if this explanation would not have been added, maybe an interpretation would have come that this local services are exempt because they are fitting in the original exemption entry, that is service by way of transportation of goods, which is exempt. So they have clarified here by putting an explanation saying that nothing contained in this entry, that is obviously the exemption, will apply to. So exemption will not apply to what? Local delivery services provided by the ECO or local delivery services provided through the ECO. Now again, this is interesting. You'll say what is by and through. So there are two types of local delivery services. One, where I am a company who is actually engaged in local delivery, whereby I create my own workforce and then I launch my app where you may book the local delivery service through my app, but the service is provided by me. I'm not taking any outsiders to provide the service. And second is, like all other apps, the app is connecting two people, me, the recipient who wants the goods to be transported, and the other persons who are available for doing this transportation. So both are covered here in this explanation. So where the app itself is providing the local delivery service, that is also kept out, means it is not exempt, or where the app is acting only as a, and there will be some person who is available nearby who will accept that particular service. Very big relief is given to all of us individuals wherever post this date. Now, this is very important. Post this date, we are booking or getting life insurance. So, two types of insurances are made exempt. So, now onwards, the premium on these insurances will be fully exempt, life and health. Now, insurance service is provided to the insurer, by the insurer to the insured and not to a group. This is what is again common in case of health insurance, that where the insurance is provided by an insurer to the insured and not a group. So what is the first important thing? That this particular exemption is not covering all the life insurances or all the health insurances. Basically, the intention is to cover individual insurances. So where we are taking our personal insurance and even personal insurance for our family, both are covered. Now you'll say, sir, but then whether family is not a group? No, they have clarified that. So let us read the explanation also. So explanation says that for the removal of doubt, it is hereby clarified. Exemption shall apply to a contract of insurance where the insured is either individual or individual and the family of the individual. So where I'm taking one personal life insurance, or like in case of health insurance, you'll find that many times the health insurance policy is taken for the family. So where I'm taking either my individual life insurance, health insurance, or whether I'm adding my family in that, both are eligible for this exemption. Now they have even clarified what will family include. Now this is interesting. In all the other definitions of family, whatever you see, there is name specified: spouse, brother, sister, etc. However, here they are saying all individuals which are insured as family. Interesting. So the law has not got into that complexity of whom they want to include and whom they want to exclude. They are simply saying that whatever your insurance company is covering in that same policy as family, we will cover it as family. So it may be your spouse, children, parents, brothers, sisters, maybe dependent, maybe not dependent. Law has nothing to do with that. Whatever your insurance company allows, the law will allow. Now, in relation to this, they have also clarified what will be included and not included in the group. We are coming to that. Before that, the original insurance and the reinsurance of the above insurance services, both are covered under exemption. So let us say if Shri Amitabh Bachchan takes a life insurance or health insurance and he has taken it of 100 crores. Now, for the insurance company who is actually insuring, it is a good business, but at the same time, it is a huge risk because God forbid anything happens, then entire 100 crores will be a huge payout. So at such times, what these insurance companies do, they either involve other insurance companies as co-insurers, or they get this reinsured. So what this 36E is clarifying, that when we are giving exemption to the original insurance company, the reinsurance of the above case will also be eligible for the exemption. Now, let me first take you to the point of group. So what is important is they have kept group insurance outside the exemption. So today group insurance is taxable. Now what is clarified, for the purpose of these entries, these are our insurance entries, both life and health. Group means what? They are clarifying group to mean group of persons who join together with a commonality of purpose or for engaging in a common economic activity other than availing the insurance, and includes. Now, this will be more clarificatory for you. Employer-employee groups. It means what? As we all know, many times the employer, maybe out of some legal compulsion or out of trade practice, is taking the insurance on the health of the employees. Or many times they take the group insurance policy for the employees. That will not be eligible for exemption, even though it may be a life or a health insurance policy. Second, what is clarified? So employer-employee groups where employer-employee relationship exists between the master group policyholder, who is the employer, and the members who are the employees. So where an employer is taking out policy on your life or health, that will not be covered. Then the second category is non-employer employee groups. Now you will say, sir, what this covers? So it will cover those cases where the firm is taking insurance of partners, company is taking insurance of directors. So such relationships are covered in the second category. And again, these insurances are taxable. So in short, what is exempt is only individual insurance or insurance of the family of the individual. That's it. Further, they have also explained what will be health insurance business. It means effecting of contracts which provides for sickness benefits, medical, surgical, hospital expenses benefits, whether for inpatient or outpatient travel cover and personal accident cover. So we all know what is health insurance. So they have just defined for clarification. Now, another important clarification added is relating to the goods transport agency. Vapas, what is important students to note is that within goods transport, again, they have excluded specifically the local delivery. So what they are saying, GTA means a person who provides services in relation to transport of goods by road and issues consignment note. Now this is the original concept definition of GTA. Now they have added something. It says, but it does not include. What they are excluding? An electronic commerce operator by whom the local delivery service is provided, or electronic commerce operator through whom the local delivery service is provided. So same, wherever local delivery services are provided, they will not be covered in GTA. So see, these are complementary clarifications. So one, in the exemption, they have put an explanation saying that exemption does not apply to these services. Further, they do not want to give them the other exemptions also. What are the other exemptions? If you recall, GTA is having some specific exemptions also, like where GTA is transporting agricultural produce or milk or salt or newspaper, that is exempt. Now, by putting this explanation that this local delivery service is either done by the app itself or it is done through the app, both are not covered in GTA. It means if you are getting your, let us say, you are booking a porter for delivering what newspapers or for delivering what food items, in exam, because in GTA, if you recall, there is a specific list of certain transportation. If you are doing transportation of those items like food grains, milk, salt, rice, pulses, military equipments, then newspapers, and also one more thing I'm missing out, relief items. So all these are exempted whenever you are doing the transportation through GTA. But If the same thing you are doing through local delivery apps, they will not be exempt. That is what is the point. Yes, correct, Swaminathan. Organic menu. Yes. So that is what is the relevance of this amendment, that when they are saying it will not be included in GTA, it means when you are doing local delivery service of these items, it will be taxable because it is not covered in GTA. Yes. Now coming to the chapter of value of supply. Now here, students, I would like to inform you, there is one amendment which is in the Finance Act 26, but that is not yet notified. But just since it is related to this, I would like to explain that. So firstly, what we are dealing with in value of supply, we are dealing with amendment in 15.3. What is 15.3? So basically 15.3 covers exclusions. Correct? I'm sure you all recall this. In that there are two types, A, B. A is discount at the time of supply, and B is post supply discount. Now for this, they are simply saying that once you are giving discount at the time or before the supply and the discount is noted on the invoice, we are going to give it, that discount is always available. For post supply discount, there are conditions put. Condition 1 is that there should be pre-existing agreement. Now, students, I would just like to inform you that this condition has been removed, but that amendment is not applicable to us because this condition has been removed through Finance Act 26, which has brought this amendment, but it is yet to be notified for effectiveness. Maybe it will be notified to be effective from 1st of October. And in any case, it will not be applicable for your exam, but just for your knowledge, because if by chance you would have read this amendment somewhere, you should know that it is not applicable to the November exams. Now, for November exams, then what is the amendment that we are discussing? We are discussing the second amendment, which is in clause 2. What is this clause 2 amendment? So let us go through this. Now, post supply discounts, that is the supply given after supply, discounts given after supply is made, these are allowed as deduction. Now, this is what we are discussing. If following conditions are satisfied, so the first condition is the pre-agreement, which, as I said, is now removed, but that is not applicable to your exams. And second is where proportionate input tax credit is reversed by the recipient. Now, this condition has also undergone some amendment wide the budget, whereby they have put a specific condition that it should be done by raising a credit note, and it is linked with the credit note section, which is logical. But again, that is not applicable to you. But for the time being, what we are discussing, what is applicable to you is, now for this second condition of clause B, that is post supply discount, the condition was that you are allowed this deduction of discount provided your recipient reverses the ITC which it has taken. So when I charge my original supply with 100 rupees and I charge GST on 100 rupees, it took ITC of entire GST on 100 rupees. Now out of 100, if I'm giving 10 rupees as discount and on 10 I'm reducing my GST, then he should correspondingly reduce his ITC on this 10 rupees discount. That is what is this point. Now, for this, there was a challenge. What was the challenge? How will the supplier come to know that whether the recipient has reversed the ITC or not? So for that, there was an old circular dated 26/6/24. What this circular said, that in order to satisfy this condition that your recipient has reversed the ITC, what you do is you take a declaration from the recipient, and in case the amount of this GST is exceeding 5 lakh rupees, you take a certificate from the chartered accountant or cost accountant of the supplier, certifying that, sorry, of the recipient, certifying that the recipient has reversed the proportionate ITC. So if the amount of ITC to be reversed is less than 5 lakhs, not exceeding 5 lakhs, the recipient itself can give a declaration and undertaking. But where it is exceeding, you need to take a certificate. Now, what is clarified now by this recent circular, that this condition is no more required. Now, an important question that will come to your mind, ki, sir, in fact, this is a very crucial condition. Why have they indirectly withdrawn this circular? So firstly, this condition is not removed. Condition remains there because that is the basis. If I am reducing my output sales, you have to reduce your ITC. That is logical. So condition remains. As I said, one amendment in the condition made is it is linked with the credit note section, but that will be applicable to you later whenever 2026 Finance Act amendments gets notified. But for the time being, what is applicable to you is that now you need not take this declaration or certificate. Now your question will be, but why? How will I come to know that whether the recipient has reversed a crate or not? My only mechanism was this certificate, was this declaration. Now, if this declaration related compliance is removed, so the earlier circular is now indirectly removed, how will the officer come to know that whether the recipient has actually reversed the ITC or not? So for this new circular is introduced saying that you don't require this certificate. But then question is, how will the officer come to know? So let me inform you students, from this date, IMS has been introduced, invoice management system, whereby whatever the supplier is uploading, maybe invoice, maybe debit note, maybe credit note, everything is reflected in the IMS portal, and the IMS portal is allowing the recipient to do accept, reject, or keep it in pending, applicable from 1st October 25. Now, importantly, if any recipient is not doing anything except reject, pending, then the IMS is such, it is again a functionality, it is so designed that it will be deemed accepted. So if you are not taking any action, the law will presume it is accepted. In this particular case, why now this old circular is withdrawn indirectly or made ineffective? For the simple reason that now you will not require any specific proof of whether the recipient has done the reversal or not, because through IMS, you will come to know what the recipient has done. So if the recipient has accepted or deemed accepted your credit note, automatically the recipient's ITC is reversed. If he has rejected, you will get an intimation stating that your credit note has been rejected. So in any case, now the officer will be able to check it through your system itself, that whether your credit note which you are raising for giving this discount is accepted or rejected. That is why this requirement of the circular of complying with the formality of declaration or certificate has been removed. Now, another amendment is in Rule 31A. Now, 31A was what? It was a special rule relating to valuation of lottery. Now, we all know lottery, betting, gambling, horse race, club, and online gaming. These are treated as specified actionable claims and they are made taxable. Well, for lottery, how the amount of GST was to be determined? It was to be determined by the back calculation method, because let us say you are purchasing a lottery ticket of 100 rupees. So you pay only 100, you don't pay anything extra. So the the valuation rule said that since 100 is the total value, we will do back calculation. So we will divide 100 by 128 so that you get to know the taxable value, and accordingly by this back calculation you can calculate the GST. Now, what is the amendment? As I informed you some time back, that slab of 12% and 28 are removed, and many of the items of 28 which are demerit are now put in 40%. Now, since it is put in 40%, hence this logical amendment was required in this valuation, whereby it said that now for doing back calculation, you will divide the face value of the ticket by 140 and multiply it by 100 to get the taxable value. So this is a logical amendment. Since the tax rate of lottery is increased from 28 to 40, a parallel amendment is required. Important. No such valuation rule is there for other items like betting, gambling, online money gaming. So that is why a parallel amendment is not required, because for them it is charged over and above. So in case of like online money gaming, it is on the bet amount. In case of your casino, it is on the amount of coins purchased. So over there, what is important to be noted is for them, this amendment is not required because over there they did not have a valuation rule for back calculation. Yes, Swaminathan, you have rightly pointed out lottery is under RC, but at the first stage. What is the first stage? See, where the state government who is running the lottery gives the lottery ticket to the lottery vendor. At that time, the government is the supplier and lottery vendor is the recipient. So in that case, you are right. It is put under RCM, whereby the lottery vendor is required to compute and pay tax under RCM. But after that, when the lottery vendor sells it further in the market, that is under forward charge. But anyways, in all cases, valuation remains in this manner. Now comes the next point. Again, clarifications relating to treatment of secondary discounts or post-sale discount. Now, this circular, students, is very critical. Please make a note. I'm very sure there will be some exam question on this. Now, don't mix. We have already seen something above. What did we see above? That whenever a post-supply discount is given, a supplier reduces his output GST liability and corresponding reduction has to be done by the recipient. This is what we saw above. But that is where the supplier is giving a GST credit note. What is a GST credit note? So for the amount of discount, the supplier raises a credit note, and in that amount of discount, it is also adding the GST and raising the credit note. Now, the moment you add GST and raise the credit note, we call it as a GST credit note, which has to then comply with requirements of credit note section, that is section 34, where the biggest requirement is of time limit. Plus, since the above condition which we saw, that the company giving the credit note will be allowed to reduce its output liability only when the recipient has reduced the ITC. This is what we were discussing above in the above circular, which is now withdrawn for the procedure. Now, because of this particular challenge, one, that credit note had a time limit to be issued, section as per section 34. Plus, the second challenge is that I will get the benefit of credit note, that is reduction in my GST liability, only if my supplier, only if my recipient has reduced its ITC. Now, because of these two restrictions, many suppliers, especially big companies, when they had to give post-sale discount, instead of following GST credit note, they followed or you can also call it as non-GST credit note. And interestingly, this is also allowed as per a very old circular, which said that to pass on post-supply discount, you may give a regular GST credit note, but then that will be subject to compliance of 34 plus compliance of the above condition that the recipient has reduced ITC, or simply, if you don't want to get into that hassle of both the compliances of 34 and of the above section 15(3)(b)(2), then you issue a accounting credit note. Now, what will be accounting credit note? So let us say, as a company, I want to give you some post-supply discount. Now, why I'm giving you discount? Now, many times you would be seeing that all these branded companies, they have their distributors, they have their wholesalers, retailers, and they give them a target that if you achieve so much of sales in this particular quarter or in this particular period or year, I will pass on you extra 0.5%, extra 1%. How I will pass on? By giving you that much credit note. And that is what is the incentive for these businesses to promote the sales of that company's products so that they get that extra 0.5%, 1%, which amounts to a good amount for them. Now, many times this post supply discount, since it is linked with the turnover, etc., the final calculation of what was your turnover of that last year, etc., gets late. And that is why by the time the companies are giving them credit note, either the time limit of credit note is gone, or second, the companies never got to know whether their recipients, that is these distributors and wholesalers, are actually reversing their ITC. So in both cases, the company was at peril. To avoid that, big companies requested the council, and the council brought in a clarification through the old circular. Let me see. Yes, this circular 92, very old circular, which said that the supplier, for giving this post supply discount, can issue financial or commercial credit notes, which I'm saying non-GST credit note. Now, the moment you are issuing non-GST credit note means what? I have to pass on the discount to you because you have achieved a turnover or sales, which will be passed on to you by raising a normal credit note without GST. So it will be a credit note, but not a GST credit note, which means there will be no reporting in the portal. Since it is a non-GST credit note, as a supplier, I need not report that credit note in the portal, and equally, you need not reverse the credit. So neither the time limit of raising credit note applies, nor the above condition which we just saw a few minutes before, that the recipient should reverse ITC applies. Nothing applies because there is no GST on this credit. So many companies found this accounting credit note as the much easier and comfortable option to pass on such post supply discounts. Great. Now, since as you can see, it is a very old credit note issued in second year of GST, that is in March 2019. So it became very commonly widespread. And today also, majority of the companies are passing on the post-sale discount using this credit note, which is non-GST credit. Now, please understand and appreciate what is happening. Now, since it is a non-GST credit note or an accounting credit note, this is the books of the supplier company. It had originally showed sales of, let us say, 100. Now it is simply giving discount of 10. Sales was 100 plus GST. Discount is only 10 without GST. Why? Because now you are not issuing a GST credit note. Interestingly, what you have to note this is that these two entries are happening in different financial year. This is sales which may have happened in the financial year 25-26, and of this entire financial year, as I said, after the end of the year, entire hisab and accounting is done, and you find out exactly how much is the discount earned, and this discount is given, which is given in the next financial year. So both these entries are happening in different profit and loss statements. Fine. For the supplier, no problem. Discount becomes their expense because to that extent, they have reduced the outstanding of their wholesalers, distributors. Now coming to the books of the recipient. Who is this wholesaler? Now it would have shown this purchase of 100 plus GST, and whenever it receives the discount, it will show this discount. Again, it is without GST. Now again, this is happening in two separate financial years. This is in 25-26, and this is happening in 26-27. Now interestingly, what these recipients started doing, they started showing this as their miscellaneous incomes. And obviously it is a indirectly type of income or benefit, because whatever discount you are earning, it is always going to your P&L credit. So it is equivalent to earning. So they called it as discount, they called it as incentives, they called it as some scheme benefits, whatever name everybody started giving. Now students, because of this accounting treatment in the books of the recipient, who are the distributors or the wholesalers, a new problem started. What started? Now these discounts were now appearing as an independent item in P&L. So the new issue that started was that the department asked them to pay separate GST on this discount. See, firstly, it is without GST, so it is only the discount amount. There is no GST component on that. Now, what the department, when they did audit of these recipients, and as you can see, this circular had come in 2019. So since then, as I said, majority of the companies opted for this. So now it is a common practice that all big companies are preferring this type of discount credit note. So they are passing on the credit note, and this is how it is reported as a miscellaneous income in next financial year. So the department asked these recipients that, boss, you have got some benefit. You are showing it as a benefit in P&L. And even though it is a discount or whatever you are calling it, but there is no GST. So they ask two things. Either you reverse your ITC because it is, as you are saying, discount relating to your purchase side. So on purchase, you have taken on entire 100, you have taken the GST ITC. So if out of 100, if 10 is reduced, you should reduce your ITC. So they were getting notices asking them to either reverse the ITC, or second notice was pay GST, treating this as a new supply. Interesting. So in some places, the department said you reverse ITC on 10. In some places, department said that you pay GST on that 10 rupees discount, which are showing as a miscellaneous income. Now to resolve this, a new circular number 251 was issued. What was clarified by this? So it clarified that the recipient is not required to reverse the ITC. And the logic is simple. Why? Because if my supplier is not reducing his GST on the output, why should I reduce my GST ITC on the input? So since supplier has not reduced his output GST, I need not reduce my input GST. So this is what is the important clarification. So recipients are not required to reverse the ITC attributed to the discount provided on the basis of financial or commercial credit notes issued by the supplier, as there is no reduction in the original transaction value of the supplier. So we are seeing that, boss, that the first transaction of 100 rupees is an independent transaction. This credit note is an independent transaction. You need not reduce your ITC. Now, then comes the second question, whether this 10 rupees of discount should be treated as a consideration. As I said, some department people felt that it is a new supply made by whom to whom, by this wholesaler distributor to the original company. So since you are showing it as a miscellaneous income, you treat it as a new supply. This 10 rupees is your consideration of that supply. So now you pay GST on the supply. Now, for this, again, a clarification was given, but this clarification is slightly tricky because it has complicated this part. See, the simple clarification, according to me, should have been that there is no separate supply. I have done extra effort. I have promoted the sales. So I got that discount. This is no new supply I'm doing. This is what is my business. So whatever discount I am getting, I need not pay GST on that. So one, I need not reverse ITC. Second, I need not pay GST on that. Now for this particular question, the circular has given a clarification, but in a very twisted manner. How? It says that check if there is any agreement between the manufacturer and the end consumer. If there is no such agreement, then it is fine. Then you will not treat it as a separate sale, as a separate supply. But in case there is an agreement between whom? Between the company, that is a manufacturer, and your end consumer, which will practically never happen. But they have considered this, that if there is a contract between the original company and the customer, then you will treat it as a supply. So I'll explain you like this. See, this is the company, manufacturer. You are the distributor and you have sold the goods to Mr. X, who is the customer, right? The company charged you initially 100 rupees plus GST. Then it gave you a 10 rupees reduction in the form of discount. Why? Because you achieved the turnover during the year. Now, the issue is when you have received this 10 rupees as a benefit from the company, is it that you have also given some supply to the company of rupees 10? Obviously, the answer is no. But for this, what they have done is they have complicated this, saying that you have to check whether the manufacturer company has a direct contract, any agreement with the customer. In case if there is no agreement, right? So first is there is no agreement between the manufacturer and the end consumer. Then there are two independent transactions. What are the independent transactions between company and you and between you and the customer? These are independent transactions. One from manufacturer to dealer and the other is dealer to the customer. In such cases, this 10 rupees will not be treated as a separate consideration. It will not be treated as a separate supply. Correct? So the discounts are given simply for competitive pricing and push sales, and therefore it is clarified that such discounts cannot be included as consideration. Means you don't have to pay any GST on this 10 rupees. But when the manufacturer and your customer has no connection. However, they brought out this interesting, I don't know from where, whose thought process was this, that if the manufacturer and the end consumer is having some arrangement, some agreement, and because of that arrangement or agreement, the manufacturer is giving you the discount, and what is the agreement? You will pass on the discount to the customer. In that particular case, they have clarified that, now this is very strange, but this is how the clarification is, that the discount given by manufacturer to dealer should be included in the overall consideration. In other words, the dealer will have to pay GST on this 10 rupees discount also, treating it as part of consideration. This is strange, but that is how the circular has clarified. So I will say that you may not get into complications much. Two simple clarifications. One, you are not required to reverse the ITC. This is the first clarification. So not required to reverse the ITC first. One second, students. Just a minute. I will reopen this. There is some problem. So first clarification is simple. You need not reverse the ITC on that 10 rupees discount. And second clarification also, you simply keep in mind that if there is no agreement, and you'll always be given this situation only, that there is no agreement, in that particular case, it is clarified that you need not consider this as a separate supply and do not consider this as a consideration. You remember this only, but just since it is given in the circular, you have to remember it that by chance, if your exam question says that the manufacturer and the end consumer is having some understanding, some arrangement, some agreement, then that 10 rupees you will have to include in your overall consideration. Which consideration? In fact, this 10 rupees will be getting added over here. So whatever is your sale price to your buyer, in that you add this 10 rupees which you have received from the customer and you pay tax on this 10 rupees here. This is what is the clarification. Is this clear, students? See, I know this was slightly tricky, slightly off the conceptual part, but that is how the clarification is given. But it is very important. I'm giving it a good time and space so that you can absorb it, because I have a strong feeling this will be there in your exams as one of the case studies. So you have to just check whether the manufacturer and your consumer has some arrangement agreement. Yes, you will add this 10 rupees in the sale price to your customer. That will be your answer. If no such thing of arrangement is given, then nothing doing of this 10 rupees, that will not be added here. You will pay tax only on your original sale price to your customer. Now, another clarification. What is the issue now? Whether this post-sale discount, which is given by manufacturer to you, can it be treated as a consideration in lieu of activities performed to promote the sale of goods? Now, students, again, I believe this was unwarranted, because logically speaking, why will I uh, take extra effort in promoting sales? Because I'm getting something extra. But that something extra does not becomes a new sale. It is part and parcel of my day-to-day activity. So it is like this. Right at the start, if the manufacturer or the company would have had confidence in me, it would have given me this discount at the start itself. Then all this complication would not have happened. But since at the start it has not given me the discount, it is giving me later on, then that too in the next financial year, and I'm showing it separately. All this complication is happening. But fine. Now, what is the next issue? Can you treat this discount as if you are giving some service to the manufacturer? Now, what is interesting is they are saying that why the manufacturer has giving discount? Because you have given some special service to the manufacturer. What is the service? Helping the manufacturer to promote their sales. Please understand, students, my understanding of the simple commercial understanding or business understanding is, I am doing extra effort, but that is to promote my business so that I earn more. I am not doing this so that the manufacturer earns more. By default, when I'm earning more, manufacturer is earning more because I am selling the products of the manufacturer only. But that does not mean that I am doing this additional service for the manufacturer. I am doing it for myself. So students, the issue is that they are saying that why the manufacturer is giving you this 10 rupees, because you have done some special effort for the manufacturer. Frankly speaking, I don't buy this logic, but fine. Now for this issue, again, the clarification is interesting. What the clarification? The circular says that whether this 10 rupees which the manufacturer has given to you, is it because you have done some extra services for the manufacturer to promote the sale of the manufacturer? So what is given? The dealer received this post-sale discount. They may engage in promotional activities to boost the sale. However, these activities ultimately enhance the sale of the dealer himself. This is the logic. So, when you are doing any extra effort, you're doing it for yourself. You're not doing it for the manufacturer. Yes, manufacturer will get benefited, but your intention is not giving benefit to the manufacturer. Your intention is getting benefit for yourself. How? Because it will be increasing your revenue. Now, in this context, discount merely reduces the sale price of goods and is not linked to any independent service. So first part of clarification is perfect. Therefore, it is clarified that post-sale discount offered by manufacturer to dealer shall not be treated as consideration for any separate transaction. Best clarification. However, again, they could have ended it here, but they have given a carve out. They are saying you will have to pay GST. That is, this will be treated as a separate service given by you to the manufacturer when you, that is a dealer, have performed some specific sales promotion activities like advertising campaigns, co-branding, customization, special sales drive, exhibition arrangement, or customer support. Where you have done any such special activity, and very important, such services are explicitly stated in the agreement with a clearly defined consideration payable for such a supply. So, where you have done any of these activities, which are called as specific sales promotion activities, and this is done as per the agreement. So, agreement has asked you to do it, and also the agreement has defined some consideration for it. In such situation, we will say that the dealer has given a service to the manufacturer. So in that case, for the 10 rupees, it will be treated as a separate supply and GST will become applicable. I hope this is clear, students. Right? Now, again in the valuation section, if you recall, valuation has three limbs: 15.1, 15.4, 15.5. One says transaction value with some plus, with some minus. Plus is given in 15.2, minus is given in 15.3. 15.3 covers basically discount. 15.4 says you have to determine value as per valuation rules. And 15.5 says that for some notified supplies, value will be prescribed. So, for the notified supplies, which are notified under 15.5, the valuation will be done in a prescribed manner. Now, what is the amendment? Now, in this list, what are the notified supplies? In that, something has been added. So firstly, what are the original notified supplies? Online money gaming, online gaming other than money gaming, actionable claims in casinos. Now, what has been added from 1st Feb 26? Following supplies are also notified in this section. What are these supplies? Pan masala, unmanufactured tobacco or tobacco waste, then manufactured items of tobacco like cigar, cheroots, cigarillos, cigarettes, etc., or other manufactured tobacco and tobacco substitutes. Further, products containing tobacco or reconstituted tobacco and intended for inhalation, like all those. It is that new culture has started, na? Hookah. And finally, products containing tobacco or nicotine substitute and again intended for inhalation. So these all products are now added in 15.5, whereby for these products now a valuation has to be prescribed, because 15.5 says what, as I explained here, that for notified supplies, how will you value? That will be prescribed. Now these are the new notified supplies in 15.5. Now what is prescribed for them? This is what is prescribed. First we'll read this, then I'll take you to the explanation or the definition. So new rule 31D, which provides that notwithstanding anything contained in this entire chapter, the value of the supply of these notified goods shall be, now this is what is interesting. So in GST, till now we were not paying tax on the retail price, only the retailer was paying tax. But now all persons in the chain, right from manufacturer to retailer, will be paying tax on the retail sale price of these goods. But obviously not the entire retail sale price, because obviously we know that retail sale price is including tax, so less the tax applicable. So in short, back calculation of the retail price. So for these same goods, now the tax amount will be calculated using the back calculation formula. So whatever is the retail price multiplied by the tax rate divided by 100 plus tax rate. And I'm sure you all know the tax rate would be nothing but 40%, 2020, 20C, 20S, or 40 entire IGST. Now, for this, we need this definitions. So first, what is your retail sale price? It is the maximum price declared on the goods. So whatever you print on the package, declared on the goods at which such goods is packaged or maybe sold to the ultimate customer and includes all taxes. So as we know, what is the retail sale price or the MRP, what we commonly call, that is now the value. Only for calculation, you do back calculation, but your value is retail price. Now, where on the package of these specified goods, more than one retail price is declared, you will take maximum. So at times you may find 2 or 3 retail prices. Now you'll say, sir, why so? So many times it is season based, many times it is area based. So it may be written that within Karnataka 10 rupees, outside Karnataka 12 rupees. We'll take 12 rupees. Further, what is clarified? Where the retail price declared on the package of the specified goods is altered. How altered? It is to increase the retail price at any stage, before, during, or after the supply. The altered retail price shall be deemed to be the retail price. So interestingly, when the manufacturer sent the goods, he printed 12 rupees on the pouch, that gutka pouch. But later on, somebody put a sticker of 15 rupees on that. Now, the provision says we will deem 15 as the retail price. So even the manufacturer or all the earlier persons are supposed to calculate the tax taking 15 rupees as the price and not 12. Even though they had printed 12 and issued at 12 only. But later on, somebody altered the price, that makes no difference. So that is why they are saying, when is this alteration happening? At any stage, either before, during, or after the sale. So even after your sale, somebody else has altered the price. Still, for you, the new price will be the altered price, which is the higher price. Next, where different retail prices are declared on different packages for sale of specified goods in package form in different areas. So as I was saying, many times different prices are for different areas. Then each such retail price shall be the retail price for the purpose of valuation intended to be sold in the area to which the retail price relates. So where there are price for different areas, then wherever you are selling the goods, you'll consider the price of that area. So if you are selling within Karnataka, so you will take 10 rupees as the price. If you are going to sell outside Karnataka, you will take 12 rupees as the price. And then other are common explanation, tariff heading, subheading, chapter shall mean, respectively the tariff heading, etc. And rules of interpretation of the first schedule to the Customs Tariff Act, including section and chapter notes, will apply. Correct? So for these notified goods, students, now the valuation says the price that you have to take is the retail price, MRP or RSP. Now coming to amendment relating to ITC chapter. Now with respect to ITC, we know the concept of input service distributor. We call it as ISD. Now, what is happening with ISD? ISD is generally your head office or your central office, correct? Now, ISD is receiving many input services, which are common input services. Common means the benefit of these services are by many of your units. So you are the head office and you have multiple units across India. So unit 1, unit 2, unit 3, we have multiple units across India. Now, we have this ITC provision in the input tax credit chapter, which says that ITC will now take a separate registration as ISD. The head office will take a separate registration as ISD, and whatever is the ITC it has received on the common input services, that ITC it has to distribute to its units in the ratio of turnover of the units. Now, in relation to this, there was one small problem. The problem was that what if ISD receives any input service like lawyers' fees? Now, we all know lawyers' fees or at times GTA, these are under RCM, where the tax is to be paid by the recipient. Now, let me inform you, students, when you will practically see this ISD mechanism, you will find that in ISD, there is no facility to pay tax. So the ISD registration, the portal of ISD is not having any tab which allows you to pay tax. So ISD is only for receiving credit and passing on the credit. There is no option given to ISD to pay the tax. Now, when this concept of ISD, which was made compulsory from the last year, 2025, a practical question later on came that you have made it compulsory that now every head office receiving common services should register as ISD and do the distribution. Fine. But the head office is receiving these services which are under RCM. The problem is, how will this ISD pay the tax on this RCM? So that is where this clarification or clarificatory amendment has come. What it says that your head office will have two registrations. One is the regular registration like all units are taking, and one is the special registration ISD. So it has said that your head office should have both the registrations, one regular and now this compulsory one, which is ISD. What the head office has to do, the head office should take these invoices in its regular registration, and regular registration is allowed to pay the tax under RCM, and whatever is the tax paid by this regular registration under RCM, that will now be invoiced to the ISD registration. So for ISD, it will become an input service. So what has been clarified that the head office will have two registrations, regular and ISD, and the regular registration will pay the RCM of these inward expenses, and it will pass on the RCM by raising an invoice on the ISD, so that now ISD will get it as input service, and then it will also distribute this RCM tax paid to the units. So that is what has been provided in this amended clarification. So what is saying, Rule 39(1) of the CGST rules specify provisions for distributing of input tax rate by the ISD. It has been amended to include reference to IGST Act. So one amendment is it is giving reference to IGST Act. So this is just a clarificatory amendment. So what is further saying, for distribution of credit in respect of input services attributable to one or more distinct persons subject to levy of tax under 9394 or under 5354, a registered person having the same PAN as the ISD may issue an invoice, or as the case may be, a credit or debit note as per sub rule 1A of 54 to transfer the credit of such common input services to the ISD. And then the ISD will get the credit which it will distribute to its units. So what it is saying, those expenses which are falling in 9394 or 5354, that is the RCM expenses, they will be first booked in this registration, which is a regular registration. Now, one more thing, students, I'm sure by now you all would be knowing that the same person having different registrations, they become distinct persons. So that is what they are saying here. So that registered person having same PAN as your ISD, it means they are talking about which person, this regular registration. Now this person will first pay tax under RCM, and then it will issue an invoice to whom? To the ISD. So for this RCM, which this regular registration of head office has paid the RCM tax, it will pass on the credit to the ISD by raising an invoice. And through this invoice, the ITC of this RCM will be passed on to the ISD first. Now for ISD, this will become an input service, and then the ISD will distribute it to its other units. Thus, the credit of services which are taxable under RCM will be received by ISD. From whom? From the other registration of the head office, which is the regular registration, and then it will be distributed by the ISD. Students, I hope this is clear to you all. These are very minute amendments, but when you understand the logic of them, why these amendments are done, then you'll understand the nature of the amendment better. Now, another amendment relating to again ITC chapter, but it has linkage with our previous amendment, which is of that pan masala and gutka. Now, what is this point? I'm sure you all know what is 86B. So 86B says that you can utilize maximum 99% of your ITC. So ITC cannot be utilized 100%. You have to compulsorily pay 1% of your tax in cash ledger. So you can utilize only 99% of your tax through the ITC, and 1% has to be paid through cash ledger. And then there are some exceptions, right? Now in this list, they have added an exception. Yes. So when firstly this is applicable if your monthly supply is exceeding 50 lakhs. Now, we all know there are some exceptions to this when you need not pay that 1% in cash, or when you can utilize the entire, you can pay the entire liability through your ITC only. No need to pay in cash first, where the said person, that is a proprietor or the karta or the managing director or any of its two partners or whole-time directors or members of managing committee, etc., etc., have paid more than 1 lakh rupees as income tax in last 2 financial years. So when you will not be required to follow this 1% rule if you are a large income taxpayer, either you or if you are a firm entity, etc., then your directors, etc. Second, where the registered person has received refund of more than 1 lakh rupees in the preceding financial year on account of unutilized ITC. So where you have taken refund of exceeding 1 lakh. Now first is refund under clause 1 or refund under clause 2. So both points are same. You have got refund of exceeding 1 lakh rupees in the last financial year, and it is either of clause 1 or clause 2. Now, another exception is the registered person has discharged his output tax liability through electronic cash ledger in excess of 1%, and this has to be applied cumulatively in the current financial year. So maybe in this month you have not paid, but if you go to your previous months of the same financial year, you have already paid tax exceeding 1% through cash. So you can club your all the months and then you can check that 1%. So if your earlier months have paid that 1%, no problem. You need not pay in the current month. And then government, public sector, local authority were excluded. Now, one more person has been excluded from this 1% rule. That is the registered person other than manufacturer. They shall be exempted from the provision of this rule in respect of goods specified in Rule 31D. What is 31D? The newly amended rule for pan masala, tobacco, etc. Now, why is this rule made? Please understand. Manufacturer, distributor, wholesaler, retailer. Now, for manufacturer, what is coming in is raw material. What is going out is this pan masala or gutka, whatever it is. Now, importantly, from distributor onwards, it is receiving the same thing, it is selling the same thing, receiving the same thing, selling the same thing, same retailer receiving the same thing, selling the same thing. And most important, manufacturer has charged GST on the RSP. Distributor also has to charge GST on the RSP. Wholesaler also has charged GST on the RSP. And retailer will also be charging GST on RSP, because we just saw that for these notified goods, which includes pan masala, tobacco, and different types of tobacco form, for all this, we just saw that for them, the valuation is RSP. Now, why manufacturer is excluded? Because in case of manufacturer, input is different, output is different. So if it is selling at RSP, it has received at a raw materials at a lower price. So manufacturer will always have a difference between his inward and outward price. But a distributor, wholesaler, retailer has received at RSP, not received means he has received for lower price, but the bill that he has got is charging GST on RSP, and his outward bill is also charging GST on RSP. So for a distributor, there is no scope of that 1% payment in cash ledger. Why? Because for distributor, he has received goods and the inward GST is same, outward GST is same. Same for wholesaler, inward GST same, outward GST same. Same for retailer, inward GST same, outward GST same. When their GST on both sides, input and output, is same, where there is a scope of paying that 1% in cash. I hope you got this. So, except for manufacturer, all other persons who are dealing in these goods, which is in the newly added rule 31D, they are excluded from this 1% rule, because for them 1% in cash is not possible, because for them on both sides tax GST is same. So when GST on both sides is same, they are not having any difference in the GST, then how come they will pay in cash ledger? So in short, whatever is the ITC received, they will utilize the same on the outward side. This is the reason why they are excluded. Who are excluded? The wholesaler, retailer, distributor of these notified goods, which we just saw, which are covered in Rule 31D. Manufacturer is still covered. So manufacturer has to follow the 1% rule, because for manufacturer, inward side GST has come on raw material and outward side GST is going on RSP. So there is a difference. So manufacturer has to follow the 1% rule. But other than manufacturer, they need not follow the 1% rule. Please make a note of all these things, students. These are very important amendments. These are very, very important for your exams. I'm sure on majority of this, your paper will be based. So kindly understand them and prepare for them thoroughly. Yes, Swami. If you have any questions, you may ask, Beta. Swaminathan, if you have any questions, anything particular you want to ask, maybe from any chapter, that is also fine. So maybe at the time of your preparations or your revision, if you have not understood anything from any chapter, we can discuss it today. Not a problem. Now, again, a new facility of registration was introduced, which said that registration will be given to you in 3 working days. See, students, this is a big boost to businesses. This point covers small businesses. So the basic purpose is that the government found that many times the businesses are uh, you'll say impacted. Why? Because the entire registration process was taking long time. So even if you apply for registration, you did not get it immediately. Many times it was month, 1.5 month, 2 months, till the time the registration process was completed. Now, in such cases, to push small businesses, this new scheme of, you can say, automated registration is introduced, which says that if you satisfy some parameters, you will be granted registration within 3 days immediately. Earlier that was 7 days, you are right, but that 7 days had conditions that if the officer wanted, he may come for a visit, and if he comes for a visit, it will be then 30 days. So that is where the entire problem was. Now here, the role of the officer is removed, Swaminathan. So now the portal will be giving you, see earlier what used to happen, which is also the practice now, that if you are not fitting in this category, what we are going to study, your application goes to the officer. Officer will check, he will issue deficiency, you will do compliance. If the officer has doubt, he will come for a physical visit. All these things was taking a huge time. So practically, before this particular new amendment, the earlier registration process was happening in month or 2 months. Now, after this was introduced, since now the officer is kept outside the loop, the registration is given by the portal itself. We have seen that within 2 to 5 minutes, forget about 3 days, 2 to 5 minutes after application, you are getting the GST number. That is the impact of this. So what it says, any person who has applied for registration under Rule 8 or Rule 12 or Rule 17. Now, these are different rules. Rule 8 is for your regular registration. 12 is where the government or the e-commerce operator has applied registration. Why? Because they want to deduct tax or collect tax. And 17 is where these United Nations organizations and these foreign entities are applying for unique identity number. They shall, upon identification on common portal, and what identification? On the basis of data analytics and risk parameters, they will be granted this registration by the portal itself in 3 days. And as I said, we have seen it is in few minutes, not even a day. Means these forms, provided they fit in this data analytics and the risk parameters, whatever is put for them, if they satisfy these two things, they are granted registration by the portal. Officer has no involvement. Yes, after the portal is giving, the officer is getting the details and the officer can go and check later on. But at least the registration is granted, your business is going. So this rule overrides the rule of verification. And as I said, whatever you file will be checked by the officer. He will issue query, etc. This is overriding that rule. This means the process of verification and approval is now gone. Now, it doesn't mean that the officer will not at all check, but first registration will be granted and later on the officer can do the checking. That is not a problem. But first checking and then granting registration, that has been found. Now, this is introduced with some parameters and conditions. Now, this is introduced for small taxpayer as per Rule 14A. So when a person has made application under Rule 8, his total output liability made to registered persons. So two things, for output liability and for B2B supplies should not exceed 2.5 lakhs per month. So that is why this is for small taxpayers. Second, your Aadhaar authentication must already be done. Now, if you satisfy this, the taxpayer can have one registration per state. So you cannot have multiple under this facility. And it override Rule 11, which provides separate registration for multiple places. So you can have separate registration for different places in the same state. But if you want this fast track registration, you will be getting only one. If you want multiple, then fine, it will be going through the regular process of verification, etc. But one registration, that will be done immediately. Now, once your Aadhaar is authenticated on the portal, the registration is granted immediately. They are saying 3 days. We have seen 2 to 5 minutes. Now, this registration has a problem. What is the problem? It is putting a limit on the quantum of your business, because it has said that your B2B supplies should not have exceeded, sorry, not supplies, the tax on your B2B supplies should not have exceeded 2.5 lakhs per month. Now, what if you want to get out of this? So that is also allowed. So the person who has taken registration under this may withdraw from this option. How? They will have to make an application in the form REG 32, signed verified through electronic verification code on the common portal, either directly or through a facilitation center, that is fine. All returns due for the period from the effective date of registration till this application are filed. Now, application for withdrawal can be filed if GST cancellation or suspension has not been initiated. That means your registration is live. There is no adverse action being taken against you, because if, let us say, already the department is uh, going to cancel your registration because you are found to be involved in any type of fraud or malpractices, then you cannot uh, change the registration or get out of this. So the condition is that you should not, your registration should not have already been cancelled or under suspension. Further, if cancellation proceedings have started after a withdrawal application is filed and the same are pending, the officer will reject the withdrawal. So even if after filing your application, if later on any type of this registration cancellation proceeding initiated, we will withdraw and we will not allow this particular option to be changed. Now, based on data analytics and this parameter, the provision of Rule 84A relating to authentication of Aadhaar number or biometric Aadhaar, taking photograph of the applicant along with the verification of copy of documents uploaded along with registration application shall also be applied to application which is for withdrawal. So for withdrawal also the same method, same parameter will follow, and then an acknowledgement will be issued electronically. A person applying for registration as a CTP shall be given a temporary reference number by the portal for making the advance deposit, and the acknowledgement shall be issued electronically. Fine. Now, changes in details. Where there is any changes in the particulars which you had given in your original form, such updation to be done before filing an application for withdrawal. Right? Now, approval or rejection of the withdrawal application. The application filed for withdrawal shall be duly verified in accordance with the prescribed process. After verification, the officer will issue an order within the prescribed period, either allowing the withdrawal or rejecting the withdrawal. Now, what is the reason of this withdrawal? Once you are allowed the withdrawal, now you will be able to furnish your output tax liability on supply of goods or service exceeding 2.5 lakhs from the first day of the succeeding month in which the order of withdrawal is passed. A registered person cannot raise their output liability beyond 2.5 lakhs for the past periods. And after getting an order allowing withdrawal, the registered person can report higher output tax liability from the next month, but they cannot change past details. So for whatever period you have taken this special registration, let me call it as special registration, your output tax cannot exceed 2.5 lakhs, especially for B2B supplies. So this is in a way a beneficial scheme also. This is in a way a restrictive scheme also. As you saw, it is indirectly restricting your business, but that is how the scheme is. So basically, this scheme is given for small businesses. And why that 2.5 lakhs is done? Because the government wants to ensure that it should not happen that you are taking this registration and we are giving it immediately in 3 days, and then you are misusing it and passing on huge amount of ITC, which may be fake. That is why they have kept the capping of 2.5 lakhs per month. So even if you are passing on fake ITC, let us say initially, we will come to know later on, but initially if you are passing, the government is only having a risk of 2.5 lakhs per month. And that is why observe, they have kept this limit for B2B supplies because only there you can pass on fake ITC. If you are making B2C supplies, not a problem. No, beta, 2.5 is total. CSI, everything combined. It is not per tax, it is total. Your total tax liability in a month, CSI, UT, everything combined cannot be more than 2.5 lakhs. So what is the logic of this? I was trying to explain the logic. So basically in past, the government has found that people are creating bogus forms only to pass on fake ITC. Now somebody may misuse this. In fact, for them, this will come as a boon because they will get registration immediately and they will start issuing bogus invoice. So that should not happen. That is why the capping of 2.5 lakhs tax liability in a month is kept. So even if you are trying to pass on more ITC, the portal is not accepting the invoice exceeding 2.5 lakhs. That is the beauty of this. So when you have registered under this particular special registration scheme of fast registration, the portal is so designed that who are given registration under this scheme, their portal is not accepting invoice where the tax liability exceeding 2.5 lakhs. So automatically your invoice uploading on the portal is restricted up to 2.5 lakhs for B2B, because only in case of B2B there is a risk of fake ITC. B2C, you can upload any number, not a problem. Now, a parallel amendment has been done in Rule 10.1. So subject to provisions of subsection 12 of section 25, where the application for grant of registration has been approved in Rule 9, 9A, 14A. That is the new rules which we just saw. A certificate of registration in form RAG 06 showing the principal place of business, additional place of business shall be made available to the applicant on the common portal, and the GSTIN shall be assigned. Subject to following. Now this is same, 2 characters for state, 10 characters for PAN, 2 characters for entity, and 1 checksum character. So everything is same. Only in this rule 10, they have included the reference of the new 2 rules that we just saw. Yes. Now coming to the chapter of e-commerce transactions. Now students, in this e-commerce transactions, what is important is that we saw this in our first chapter also, that under 9.5 and 5.5, the e-commerce operator are made liable to pay tax. And in the list of notified services, what is added is this new local delivery service. So this is what we saw in the first chapter also. So this is not a new amendment for us. Now, filing of annual returns. Now, we all know that you are required to file annual return in GST 9, but they are giving relaxation to small businesses. So section 44.1 provides that the commissioner may, on recommendation of council, exempt any class of registered person from filing annual returns. So exercising this power, the commissioner has, in respect of filing annual return for the financial year 24-25 onwards, now this applies to all the further years, has exempted those registered persons whose aggregate turnover is up to 2 crores. So whose turnover is not exceeding 2 crores, they need not file the annual return of that year. Now, similar to fast registration, students, a parallel, or I'll say a similar amendment is made in the refund chapter also. Now, what does the refund chapter says? Provisional refund to be granted on the basis of identification and evaluation of risk. So the proper officer, on the basis of identification and evaluation of risk by the system, shall make an order in the prescribed form sanctioning the amount of refund of the said application on the provisional basis within a period of 7 days from the date of acknowledgement under Rule 91 and 2. Further, the proper officer for reason to be recorded in writing may grant refund on provisional basis and proceed with the order under Rule 92. So he may disallow the refund, but for that he will have to give reasons. Otherwise, the refund will now be given within 7 days. Further, said order shall not be required to be revalidated by the proper officer. Now, persons who will not be allowed refund on provisional basis. So 54(6) stipulates that the proper officer may, in case any claim of refund on account of zero rated supply of goods or service or both, or other than such category of registered persons as may be notified by the government, refund on a provisional basis 90% in such a manner subject to such conditions as may be prescribed. So what is important is already we had this provisional refund, but that was only for zero rated supply. So it was limiting the benefit of this provisional refund only to zero rated supply. Now, because of this amendment, it is covering all types of refund. That is what is the amendment. Now, any person who has not undergone Aadhaar authentication. Now, these are the ones who will not be given the provisional refunds. First, those who have not undergone Aadhaar authentication. Second, the persons who are engaged in the supply of following goods. So again, these are the goods where the government has identified that there is a scope or there is a past history of fake refunds or bogus ITC being claimed. Hence, they have put these goods refunds in the exception whereby their refund will not be allowed immediately on provisional basis. The officer will first do the entire checking and then only the refund claim will be passed. But other than these, that is these goods, for all other goods where the Aadhaar authentication of the registered person is already done, the refund would be allowed on provisional basis immediately. And importantly, now it is not limited only to export refunds. It is now covering even IDS refunds. Now, monetary limits. Now, whenever a show cause notice has to be issued, the show cause notice can be issued and the order against that show cause be passed only where the proper officer has the monetary jurisdiction. So there are two types of jurisdiction, students. One is territorial. So only the officer of your area can do this. And second, within your area's GST department, the officer who is of a particular rank can only do this. Now this ranking is based on the amount involved. So a superintendent can pass an order where the CGST is up to 10 lakhs. Similarly, SGST is up to 10 lakhs, or IGST is 20 lakhs, or C plus I is up to 20 lakhs. Where the amount is exceeding 20 and it is up to 2 crores, then the deputy or the assistant commissioner, so ACDC, can pass this order. And where the amount is exceeding 2 crores and there is no upper limit, if your show causes of this amount, then the additional or the joint commissioner has the power to adjudicate. Now, what is clarified that where a show cause notice is issued under 74, and now we know earlier we had two separate sections, 73, 74. Now we have a combined section and it involves both demand of CGST, IGST, and including says the proper officer shall be determined on the basis of combined amount of CIS and cess, irrespective of individual amounts. So maybe individual amount may not have exceeded the limit, but if the combined amount has exceeded the limit, then the officer will be decided by checking the combined amount. The proper officer shall be determined based on the highest amount of tax specified in the show cause and statement across all tax periods. So if a show cause is covering multiple years, then out of the different years, whichever year is having the highest tax amount, that will be the basis for determining the officer. So let us say notice is issued for 22, 23, 23, 24, and 24, 25. This is having a tax, total tax of 1 crore. This is having 50 lakhs. This is having 90 lakhs. Then I will take this as the basis for determining who should be the officer having the power to do the adjudication. Then in offences and penalties, same monetary limits prescribed for issuance of show cause and passing of orders under 122. So we know 122 is the section of penalty, and again the same limit is given for superintendent not exceeding 20 lakhs, for deputy commissioner, assistant commissioner above 20 but not exceeding 2 crores, and for joint commissioner, additional commissioner above 2 crores without any limit. Further, it is clarified that where the show cause notice is issued under this section involving demand of penalty in relation to both C and I, the proper officer will be determined on the basis of combined amount. So same clarification for tax amount show cause also and for penalty amount show cause also. Now, rules pertaining to appeals to appellate tribunal. Now we all know GSTAT, that is GST Appellate Tribunal, has started. Swaminathan, limit for SGST same. Why it is not given here? Because we are studying the CGST Act and IGST Act in our syllabus. So you see the first column, which is only for CGST. Over there, the limits are half, right? 10 lakhs, 1 crore, so on. So same thing, same is the limit for SGST. Why that is not given over here? You will find that in all chapters, we are not referring to SGST because we always cover in our exam central laws. That is why always C and I is referred. But wherever C is referred, you should always keep in mind a parallel limit of SGST is there. Now, students, we all know that now GST Appellate Tribunal has started. Now again, in Appellate Tribunal, who will be empowered to handle appeal and of what amount? Now the tribunal will be having either a single member bench, that is where there will be one member, or it will be having a two-member bench, which is also called as division bench. Now, what are the changes that have been made? So a single member bench appeal, which is involving ITC or fine, fees, penalty, or tax, a single member bench can determine and pass any order provided the amount is not exceeding 50 lakhs and also it should not involve question of law. So condition is the amount should not exceed 50 lakhs and question of law is not involved, then single member bench can decide the case. Further, there could be some conditions as may be given by the council. It may be heard by single member and in all other cases it will be heard by two members. Now, what is clarified? For the purpose of reckoning this 50 lakhs, the cumulative tax, ITC involved or fine, fees, penalty shall be determined with reference to all issues and all tax periods covered in the order. So what is the clarification? How to calculate this 50 lakhs? So it is saying you will cumulate the tax involved in all the issues and you will also cumulate if there are multiple periods involved, tax involved in all the periods. So 50 lakhs is the cumulative amount and not tax wise or period wise amount. Next. Rule 110, 111 dealing with appeal to appellate tribunal has been amended as under. First, who can file appeal? The loss is aggrieved person. Now, how it can file appeal? The person who is filing the appeal, that is the taxpayer, will use form APL 05 and it will upload relevant documents electronically. And after doing that, provisional assessment in part A of form APL 02A will be given to the appellant immediately. Now, earlier, now this has been deleted, the appellant was allowed to file this manually. However, this has been deleted. So now it is compulsory for everyone to file appeal electronically and you will be getting a temporary acknowledgement in APL 02A. Now, similarly, where the department wants to file the appeal, the form is APL 07. And again, after filing the appeal, the department will also get acknowledgement in the same form APL 02A. Again, manual filing has been removed even for the department. Then, now let us say department has filed appeal, then the taxpayer files cross objection. If taxpayer has filed appeal, the department can file cross objection. It is to be filed in form APL 06. And again, the manual option of filing cross objection has been removed. So in all cases, manual appeal, manual cross objection, all are removed. Fine. Students will take a break here. After break, we come back and we deal with the other points. Thank you. So let us go for break. Now, where the order appealed against is uploaded on the common portal, a final acknowledgement indicating appeal number will be issued in part B of Form API 02A. And the date of issue of the provisional acknowledgement shall be considered at date of final acknowledgement. If order appeal again is not uploaded on the portal, the appellant shall submit a self-certified copy of the order within 7 days from the date of filing the appeal, and a final acknowledgement indicating appeal number shall be given in Part B of APL 02A on removal of defects. And again, the date of issue of acknowledgement provisional shall be considered as filing of appeal. So basically here, the acknowledgement number, which was earlier 02, has been changed to Part B of APL 02A. Next, Rule 113, dealing with order of the appellate tribunal, has been amended to provide as under. So earlier, what was the old rule? The jurisdiction officer shall issue a statement in Form APL 04, clearly indicating the final amount of demand confirmed by the appellate tribunal. Now the amendment is the appellate tribunal shall, along with its order under subsection 1 of 113, issue or cause to be issued a summary of the order in APL 04A, clearly indicating the final amount of demand confirmed by the tribunal. So as you can see, the forms, old forms have been replaced by forms with A as the suffix. Now coming to the customs part. In customs part, the first amendment is relating to finalization of provisional assessment. So if you all remember, students, section 18 of the Customs Act deals with provisional assessment, whereby it is provided that where you as an importer are unable to make your self-assessment because you have doubt about the value or the tax rate or the exemption, you can make an application to the officer and the officer will do your assessment. Now it may happen that even the officer is not in a position to make your proper assessment. In that particular case, the officer will give you a temporary rate or value, and taking that temporary rate or value, you can do your assessment. And later on, when you provide the further details, the officer will be finalizing your assessment. Now in this particular case, what are the amendments? So CBIC has substituted the earlier custom finalization of provisional assessment regulation 18 by the regulation 2025. Now, what is the new regulation say? The time limit and manner of submission of documents or information for the purpose of finalization of provisional assessment. So where duty leviable on import or export goods is assessed provisionally by the proper officer. Why? Because necessary documents had not been furnished by the importer at the time of provisional assessment. Now, the proper officer must, within 15 days of the provisional assessment, inform the importer exporter in writing the specific documents or information which they need to produce. Then, after this, the importer exporter must make available these documents maximum within 2 months from the date of acquisition by the officer. Extension allowed for submission. The proper officer may, for reasons to be recorded, allow further period not exceeding 2 months. So original 2 plus 2. Then an officer to whom the proper officer is subordinate may allow additional time as deemed fit on request of the importer or exporter, but no extension under this regulation may be allowed beyond 14 months. So original officer allows original 2 plus 2, 4, and the superior officer may allow further extension, but not beyond 14 months of the original provisional assessment. Now, where document information are not made available within the time allowed, as per the above provisions, the proper officer shall proceed to finalize the provisional assessment based on available record. On submission of all documents information, the importer exporter shall inform the officer in writing that he has submitted the document information which was requisition. Now, so first time limit is given on you to submit that additional information. Now next, time limit to conclude the inquiry for finalizing the provisional assessment. So where duty leviable on the goods is assessed provisionally by the proper officer. Why? Because there was shortfall of some details, or the officer had to complete the inquiry and transfer the document along with the report, it should be done within 14 days. So the maximum time allowed for completing the provisional assessment is 14 months from the date of provisional assessment. During such inquiry, if any documents information is required, the proper officer may seek such details within the prescribed time limit. Now, the payment of duty of own ascertainment before finalization. So, before the officer can make the final assessment, you can by yourself make the payment of duty. So, importer exporter may pay an amount electronically against the bill of entry on his own ascertainment during the pendency of the provisional assessment. Now, why he will pay? To avoid interest. This amount shall be adjusted against the duty finally assessed. However, importer exporter is also liable to pay interest on the above amount so paid voluntarily consequent to final assessment or reassessment order. Time limit for finalization of provisional assessment. Now, what is the time limit given? The proper officer shall finalize the duty provisionally assessed where it is possible to do so within 3 months of the receipt of documents or information from the importer exporter or expiry of the time given for submitting these documents, or conclusion of inquiry in accordance with regulation 5 where the duty leviable was assessed provisionally for that reason. So where the officer had done provisional assessment because it had to do some inquiry, do some chemical test, then upon conclusion of the inquiry or chemical test, it should be done. Now, the officer who is superior to this officer may allow an additional time of 2 months. However, the assessment shall be finalized within 2 years from the date of provisional assessment. Swaminathan, it will be done very soon, beta. Next, proper officer unable to finally assess duty within the specified time. So where the proper officer is unable to assess the duty within the time prescribed for the reason that 1. Information sought from an authority outside India through a legal process or an appeal in a similar matter of the same person or any other person is pending at the higher forum, or an interim stay has been issued by some higher forum, or the board has in a similar matter issued specific directions to keep the matter pending, or importer exporter has a pending application before settlement commission. Now, in all these cases, the proper officer shall inform the importer exporter concerned the reason for non-finalization of the provisional assessment, and in case time of 2 years for finalization of assessment done no more existent. Next, manner of finalization of provisional assessment. The provisional assessment shall be finalized as per section 18, where the final assessment is contrary to provisional assessment. The proper officer shall pass a speaking order following principles of natural justice. So what is that? So if the order is adverse, importer is to pay the deficiency of the amount finally assessed or reassessed after adjustment of the amount already paid, the bill of subsequent to finalization. So on finalization of provisional assessment where the final assessment has confirmed the provisional assessment or duty along with interest has been paid in full in case of home consumption or exportation, where the bill of entry or shipping bill has been written for payment, or importer has executed appropriate bond binding himself in relation to excess duty in case of warehouse goods, then what will happen? The bond executed at the time of provisional assessment shall be cancelled or recredited as the case may be, and the security shall be returned. Further, where duty, interest, penalty or any other sum due has not been paid for more than 90 days, which is due to be paid after finalization of the provisional assessment, the sum due has attained finality for recovery, then the sum due which remains unpaid shall be adjusted from the security, if any, obtained at the time of provisional assessment, or shall be recovered as the sum due, including the amount of interest to the central government. Where the importer exporter is entitled to a refund after finalization of provisional assessment, the refund shall be processed as per this section. Now, extension of time limit for provisional assessment. Notwithstanding the time limit provided in other regulation, the Commissioner of Customs may on sufficient cause being shown and for reasons to be recorded extend the period of 2 years for finalization of provisional assessment by additional period of 1 more year. And finally, penalty, the importer, exporter or his authorized representative or custom broker who contravenes any of the provisions of these regulations or abet such contravention or fails to comply with any provisions of these regulations will be liable to penalty as per section 158 subsection 2 clause 2 of the Customs Act without prejudice to any other action. Next amendment is in foreign trade policy. The road stamp scheme is now extended up to 31st of March 26. So under FTP 2023, not eligible for the said scheme. Subsequently, the scheme was extended to AA, that is advance authorization. For advance authorization holders, EOUS is up to 31st March 26. Now, students, besides this, a very important amendment that you all should know is that now the baggage rules in customs have been re-notified. Now, let me just give you a background. So, whenever a person is traveling, a person may be a passenger or a crew member, they carry their luggage. This luggage is called as baggage. Now, whenever you are carrying baggage or luggage, you are allowed to carry certain value of goods duty free in your bona fide baggage. So whatever goods are there in your bona fide baggage, bona fide means which you have honestly declared at the arrival port airport and nothing is being concealed. Such baggage is called as bona fide baggage. Now in your bona fide baggage, articles up to certain value are allowed duty free. That is, in short, they are given exemption, and only on the excess amount of the baggage you have to pay the customs duty. Now this rule has undergone amendment for obvious reason that the limits given were very old, plus certain rules needed to be redefined. So that has been now changed. So first, in these new rules, the effective date is 2nd February 2026. Now, in these rules, unless the context otherwise require, Act means Customs Act, annexure means annexure appended to the rules, appendix means the appendix appended to these rules. Now, foreigner with a valid visa other than tourist visa means a foreigner possessing a valid visa other than a tourist visa and staying in India for more than 6 months. So in short, it has two meanings. Firstly, foreigner with valid visa will not include the persons who are tourists, that is, who have come for a short period. Second, they will include those persons who stay in India is more than 6 months. And thirdly, they should have a valid visa. It means they are not here illegally. Then infant means a child whose age is not more than 2 years. Jewelry means article of adornment ordinarily worn by a person and made of gold, silver, platinum, or other precious metal, and whether or not studded with precious stones. Personal effects means all articles, new or old, which a passenger may reasonably require for his personal use during the journey, taking into account all the circumstances of the journey. So, like if you are going to a place which is having heavy snow, so special clothing for snow, gumboots, etc., will be allowed. Where you are going to places which are having severe cold, extra clothing for winters will be allowed. Where there is heavy rains or uh, that type of weather, so raincoats and special jackets would be allowed. So depending upon circumstances, what will be allowed as your personal effects, that depends upon the nature of your journey and the travel conditions. Resident means a person ordinarily residing in India and holding a valid passport issued under the Passport Act. Tourist means a person not ordinarily residing in India and who enters India for not more than 6 months in the course of 12 months period for legitimate non-immigrant purposes. And then finally, words and expressions used and not defined in these rules will be taken from the Customs Act. Now we start with the baggage rules, that is how much is allowed duty free. So A passenger, which also now include infant, arriving in India shall be allowed clearance of used personal effects required for satisfying daily necessities of life and travel souvenir carried on the person in his bona fide baggage free of duty. So your personal effects are allowed duty free except the articles in Annexure 1. If you all remember, we have 3 annexures. The annexures remain same. There is no change in that. So what is now the change? The change is in Rule 3. They have not given any amount. They have simply said all personal effects are allowed duty free. Now moving further. Now this is something new. Provision for re-import and temporary import. Any article of personal effect other than used personal effects required for satisfying daily necessities of life taken out earlier by the resident or tourist of Indian origin or foreigner with a valid visa other than tourist visa or members of his family from India shall be allowed free of duty on submission of declaration made at the time of his departure from India electronically. So what is the point? So now whatever you had taken out, when you are bringing back, and let us say they are not used personal effects, so they are new, because see, all challenges with new. If something is used, there is no problem. But if something is new, then there is exemption subject to a certain monetary limit. But what this rule 4 says, if these things were taken out by you in the first place, then when you are bringing it back to India and you are providing a declaration which you had made at the time of departure, then this will also be allowed to be taken duty free. Next, articles of personal effects, again other than used personal effects required for satisfying daily necessities of life carried by a tourist required for his stay in India may be allowed to be imported temporarily free of duty on submission of a declaration and subject to their re-export. So whatever you are bringing other than used means they are new, but you are giving a declaration that they are for your use in India till the time you are here and you will take it back. The persons availing the facility under this rule may be subject to risk-based verification. So here, if you have a past history of some fraudulent practice, you may not be given this benefit. Next. Now see, the allowances have now been increased. This was the purpose of bringing the new rules, plus adding some more concepts like person with a valid visa. All these things were not there in the old rules. They have been added. Now, what is the general duty-free allowance? So a resident or a tourist of Indian origin or a foreigner with valid visa other than tourist visa and not being an infant arriving in India other than by land shall be allowed clearance free of duty. Articles except Annexure 1 up to a value of 75,000 rupees if such articles are carried on the person on the bona fide baggage, provided that tourist of foreign origin, so Indian origin are given 75, arriving in India other than by land shall be allowed clearance duty free other than those specified in Annexure 1 up to a value of. So if you are resident of India or tourist of Indian origin, then your duty-free allowance is 75,000. But if you are a tourist of foreign origin, then your duty-free allowance is up to 25,000 rupees. Further, where the passenger is arriving in India by land, personal effects required for satisfying daily necessities shall be allowed duty-free. So here they will have no extra amount, only the used personal effects are allowed duty-free. Provided also that passengers of 18 years of age or above other than crew member shall be allowed clearance of one new laptop, including notepad, free of duty. For the purpose of this rule, the free allowance of a passenger shall not be allowed to be pooled with other passenger. So this is borrowed from the old rule. So independently or individually, you have to claim your 75,000, 25,000 allowance. Now, for jewelry, what is given? A resident tourist of Indian origin residing abroad for more than 1 year. This is common from the old rule. On the return to India shall be allowed duty-free clearance up to a weight of 40 grams if brought by a female, or 20 grams if brought by a passenger other than female. Now, what is the change? If you remember earlier, besides the weight, there was a limit on value. Now, we all know gold prices are changing regularly, and in past few months, they have shot up with an alarming rate. Hence, very judiciously, the new rules have not given the amount limit, which according to me is a very good change. So, in the new rules, only the quantity limit is there, amount limit is not there. Yes, Swaminathan, that was the old limit. You are correct. Now that value has been removed and it is logical. Then comes, students, another very important rule many times asked in the exams: transfer of residence. So this is applicable where you are staying abroad for work for some period of time, means now you had shifted your residence abroad and now you want to come to India. So you are transferring your residence to India because maybe your project, your work, or whatever reason you had gone is now over. Now in this case, besides the above allowance, you are given additional allowance, because when you are shifting residence, maybe you will be bringing, besides your personal effect, you will be bringing some utensils, etc. So what is given? Resident, tourists of Indian origin who were engaged in some profession outside and now they are transferring their residence shall on return be allowed clearance free of duty, in addition to what is allowed in Rule 3 and Rule 5. So what we studied above, besides that, articles in the bona fide baggage to the extent mentioned in column 2, subject to conditions mentioned in column 3, and relaxed to such extent by the authorities in column 4 of Appendix 1. Further, a foreigner with a valid visa other than a tourist visa engaged again in a profession in India on transferring his residence to India or arrival shall be allowed clearance free of duty, in addition to what is allowed in Rule 3, Rule 5, articles mentioned in the bona fide baggage in column 2, subject to conditions in column 3, with some additional relaxation in column 4, which are in Appendix 2. So when you are a resident of India or a tourist of Indian origin and returning back to India, you are allowed the allowance as per Appendix 1. When you are a foreigner and you are transferring your residence to India, you are allowed as per Appendix 2. Then besides this, the personal and household articles specified in Annexure 2 may be brought on transfer of residence up to the value mentioned in Appendix 1 and 2. So not only personal effects, your household articles also. And where there is a shortfall in the currency department or authority of the central government concerned with this. Now, unaccompanied baggage. Again, if you remember, students, this was there in the old rules also. What is unaccompanied baggage? The baggage which is not coming with you. So either it has come prior to you or it will come after your arrival. Now, what the provision says, these rules shall apply to even unaccompanied baggage. So the same exemption, same exclusion which is given to your accompanied baggage will also be given to unaccompanied baggage. Unaccompanied baggage arrival. So if it is coming before you, passenger or his member of family or any type of natural calamity or disrupt conditions or created a change in travel schedules. And further, what it says, these rules shall also apply to crew members engaged in foreign going conveyance for importation of their baggage at the time of final payoff or termination. So same rule which is applicable to passengers on gold, that according to me is one of the major change, right? Now let us do few questions which I believe are going to be important for exams. So let us discuss them. I'm taking this question 12,000. Okay. Under forward charge on 15th August. for which tax invoice was also issued on the same date. So 24,000 on 20th September. Obviously, so August return you have filed in September by filing GSTR 3B for August month to avail the ITC. You have the tax invoice, the goods are received, assuming the supplier has also paid tax, but you have not made payment to the supplier. Do not restrict you to take ITC if the payment is not done. So yes, immediately you can get the ITC in the same month. But if these goods or services are on credit, then the provision requires that you make payment within 180 days from the date of invoice. So date of invoice is 15th August. Now you have to count 180 days. Now what the question further says, if the Mohan makes payment of this amount to the supplier on 18th March. So from here, you count 180 days. So roughly it will be somewhere in February. 180 days. Exact, we'll have to count whether it is 13th or 14th or 15th. Now, the point is, when your 180 days are over, the law requires you to make the reversal. So, since you have not made payment up to February because you are making somewhere in March, immediately when you are filing the February return, you will have to reverse the ITC provision. And yes, you are correct, Swaminathan. If the amount is paid partially, then you will have to do the partial reversal to the extent of the amount not paid. Yes. So this is again a good question. With reference to provisions of Section 17, examine the availability of ITC in independent cases. First, MBF Automobile Company has availed works contract service for construction of a foundation on which a machinery is to be mounted permanently. Now, what is the challenge? Section 17.5C and D, they have a problem wherever you do expenses on construction of immovable property. Now, you have done construction of a foundation. So for the machine, you require the base. So you have created that base. And the machine will be mounted on that particular base permanently. Now the question is, whatever expense you have done for the construction of this base, whether it is allowed or not allowed. Yes. Any inputs? Very good, Swaminath. So the answer is it is allowed. Why? Because the exception to 17.5C and D is plant and machinery. So for plant and machinery, Section 17.5C and D does not apply. And in the definition of plant and machinery, they have included the construction of the foundation or the structural support required for the machinery. So since you have done the construction of the foundation required for the machinery, hence you are allowed the ITC. Next, Shah & Construction procured cement, paint, iron rods, and architect services and interior design services for construction of a commercial complex for its clients. So Shah & Construction has procured these items because it wants to construct a commercial complex for its clients. Whether ITC is allowed. Yes, correct. So again, students, here also ITC will be allowed because you are not doing construction on your own account. So if you would have done construction for your own self, that is this construction of commercial complex or factories for your own use, ITC would not have been allowed. But since you are going to give this as a supply, so this construction is your outward supply, hence ITC will be allowed. Next, ABC availed maintenance and repair service from Jaggi Motors for a truck used for transporting its finished goods. Now, this is the first restriction under 17.5A. So AAAB, where there is restriction relating to motor car. So first on purchase of motor car plus on all these expenses like repairs, maintenance, insurance. Now here you have done repair maintenance of truck, whether ITC is allowed. The challenge is the restriction relating to motor car and its allied expenses, whether this will be allowed or it will be blocked. Very good, Swaminath. So as rightly pointed out by Swaminathan, that here What is restricted is passenger related motor vehicles, not goods related. So wherever you are purchasing trucks, or here in this case, you are spending on the repairs, maintenance, insurance, servicing of the trucks, the expenses for goods transportation vehicle are not blocked, they are allowed. So here you will be fully allowed this IDC. Now, 25th August, Messrs. Agrawal and Agrawal, a registered supplier of taxable goods located in Bangalore, purchased one machine. Okay. For this amount, including IGST, from one supplier of Maharashtra who issued invoice on the same date. It received the machinery on the same day. Available. How much you will have to pay? Yes. What will happen? So the answer is, as per section 18.6, you have to pay higher of two amounts. First, tax on the transaction value. So you have sold the machine for 750, 750 multiplied by 18%. Or the proportionate ITC. Now, how will you find out proportionate ITC? How much ITC originally you have availed? What is your original ITC? 1239 is 118, correct? So how much am I getting? 1239 divided by 118 into 18 is my original ITC minus. How many quarters have I used? Now interest, so as per law, 5 quarters have to be taken, 5% per quarter. So it is 25%. So 189 minus 25% of 189. So how much is left? So what is left over here is 141,750. And here, how much is your transaction value? You have sold it for 750 into 18%. This is coming to 135. You have to pay whichever is higher, that is 141,750. Correct. Perfect. So we both are on the same page. Same answer you are also getting, right? Next. Krishna Motors is a car dealer selling cars of an international car company. It provides maintenance and repair service of cars sold by it, as also of other cars. Okay. It seeks your advice on the availability of ITC in respect of cars purchased from the manufacturer for making further supply of such cars. 2 of such cars are destroyed in accident while being used for test drive by the potential customers. Okay. So what is the question? You have to advise whether ITC will be available in respect of cars purchased from the manufacturer. Obviously, the answer is yes. Now, 2 cars were destroyed by accident. So out of all the cars you purchased, 2 cars were destroyed by accidents. What will happen? As per 75H, you'll have to reverse the ITC of these 2 cars. Because whenever goods are lost, destroyed, the ITC on those goods is blocked by 17.5H. So we'll have to reverse them. Now, yes, correct. Now, with the help of information given below in respect of manufacturer for the month of September, compute ITC. I think we do not have the time to complete this. Let me go to case study question because that we can complete. X, a manufacturer of roofing sheets, is having 1,60,000 as opening balance of ITC. He provides the following information pertaining. Again, this will require calculation. We are short of time, so we may not be able to solve them all. I think there are no more case study questions. All are solving questions only. See, chalo, at least what we can do is we can at least identify what is eligible, what is not. So we Supply Private Limited is a registered manufacturer of auto parts in Kolkata. The company has manufacturing facility registered under Factories Act. It procures its inputs indigenously from both registered and unregistered suppliers located within and outside the state. Plus, it also imports raw material from China. Now, company reports following details. Raw materials 3.5 lakhs. Sales 15 lakhs. Okay. Consumables, this much transport charges, salary paid to employee, premium, audit fees, telephone, etc. Okay. All the amounts are exclusive of all kinds of taxes wherever applicable. Now, further information details are furnished in respect of following payments. Raw material amounting to 0.8 lakhs is procured from Bihar, 1.5 is imported from China, basic custom duty 0.5, social welfare surcharge, and IGST are paid on raw materials. So these are all eligible for item, and for whatever you have procured from registered, you can take ITC. For the raw material worth 0.05 lakhs purchased from registered supplier, you will not be eligible, so you'll have to reverse. Consumables are procured from registered suppliers located in Kolkata and include diesel worth 0.25 for running the generator. There is no GST on diesel, so there is no question of ITC on the diesel. But other than diesel, for remaining consumable products, you will get ITC. Now, transport charges comprises 0.6 lakhs paid to GT in Kolkata and 0.1 lakh paid to horse-pulled carts. GST applicable on service of GT is 5%. Now, on horse-pulled carts, there is no GST and you are required to compare. Last session in our LVRC class, I am sure through all these sessions, you would have gained a thorough understanding of the entire paper with inputs on various special aspects of each chapter and how they are relevant to exams. I am sure this all will help you in a proper preparation and also in securing best marks. So with this, we conclude our LVRC classes for the November attempt for this paper of paper 5 of indirect tax laws. And thank you very much, and be in touch with us so that wherever there are any problems, there are any queries, you can get it resolved. So thank you, students, and very, very best of luck. Good day. Yes, Swaminathan, good night. Thank you, Ashok ji. Yes, Ashok ji. Thank you. Good night.